as I said before, parent plus borrowers do nothing. They will not be on a repayment plan where forgiveness is an option. But if they do that double consolidation, they can unlock those lower payments, make them affordable within their budget, and then they can pursue either public service loan forgiveness or income-driven forgiveness. That's more of a long-term forgiveness.
When you need some advice, never sacrifice, always get it right. Ask the plan man. Finance, insurance, and more.
Hi, everybody. Welcome back to Ask the Plan Man. I'm excited to have financial advisor Glenn Sanger-Hodgson with me. Today, we're going to talk about college planning options and student loan challenges that are going out in today's environment. This is the beginning of 2025, and the current administration is going to change over. And they've been eliminating a lot of people's student loan balances. And, many people wonder, how do they participate in that? And what they need to be doing. Glenn, welcome to the show. You're a financial advisor up in Northern Florida. Tell everybody a little bit about you, your background, and then let's kind of break down sequential options are in the college savings world so that if they have time to put money away, certainly do that. And then we'll pivot into the student loan process because a lot of people are relying on the student loans, right? So.
Exactly. Yeah. Thank you, Bruce. And my primary work is as a financial planner with Shonen Gold Financial. And the genesis of it really was that previously I had been spending time working at the Florida State University College of Medicine for a number of years and came to recognize a tremendous need for graduates of medical school to have financial planning who are otherwise underserved by traditional financial planning services because they typically have hundreds of thousands of dollars in student loans and very little in the way of investable assets. And so I've really kind of set out to make student loan planning central to my mission and those that I help. And that's kind of what brings me here today as well. I know Bruce said we're going to start with talking about paying for college or trying to save and plan for that college planning element. Which is fantastic if you have, time and runway to help your children pay for their college education. But also I see the flip side too with a lot of parents who didn't really plan and save and ended up having to take out Parent Plus loans. So I'll just kind of tease. That's one of the big reasons why I wanted to be here today is there is a deadline coming up. It is June 30th this year of 2025. That if you happen to have Parent Plus loans, there's some things that you need to do and complete by that deadline in order to unlock access to all the repayment plans and have flexibility with that. But
so what is that? So stay on that. So what does that mean when you say unlock?
Yeah. So the challenge with Parent Plus loans is they're actually the most expensive and the most restrictive student loans available. And typically what happens is children will get for their undergraduate, they'll get their financial aid package, and there's certain limits on how much in student loans that the students are able to take out. But that typically is less than by thousands of dollars, if not tens of thousands of dollars, than the actual cost of attendance for those students to attend college. And Parent Plus loans then are one way that a lot of people bridge that gap.
So it's like a second tier loan. So your first line would be using your own money. Then we get financial aid where we maybe take off $5,000 or $10,000, or in my case, I was given like a work program, like I could get a job and have X amount of money earned that I could apply towards it. And then if there's still not enough, if people don't have an asset like a home equity line or a 401k to borrow against, then you're saying there's this loan. Is that
exactly? Once all those other sources have been tapped.
And then again, let's just educate a little bit. So correct me if I'm wrong. It's been a long time since I was in that world. The student loan directly in the child is deferred payments until graduation. And then maybe 6 months after graduation. Is that still accurate?
Yep, it's a 6 month grace period.
And those rates are relatively modest. I don't know what they're based off of, but when I was a kid a million years ago, I knew people you could get a 2,000. That was it. Back in the late 70s and early 80s, Glenn. And the interest rates on CDs were higher than the loans. And I know people who had the money and their parents borrowed the money, took the 2,000, put it in a CD, and kept the spread and got a 4-year CD at 15%, borrowed it at 9%, waited till the kid graduated, paid it off, and they kept the interest. I don't think you could do that these days. Rates aren't that high, but
I just looked it up for you, Bruce, because I didn't know the number exactly off the top of my head. Student loan interest rates, they're fixed interest rates. For undergraduates, it is 6.53%. For graduate loans, it is 8.08%. And then, as I mentioned earlier, those Parent Plus loans are some of the most expensive ones.
Right.
They're coming with a 9.08% interest rate right now.
So about 1% more than the graduate level.
Exactly.
But 2.5% more than the student's rate.
Yep. So,
and that's also a larger amount, right? And not deferred. True. The parents.
Just for those who may be listening who have children or thinking about having children in college, it can be deferred, but you have to specifically request that it be deferred. It's not automatic in the case of the children's student loans.
But you're getting 9% compounded for 4 years is over 40% more on the loan balance by the time they finish.
Yep,
right?
And it does start
on the first loan.
Yes,
Say again?
And it starts accruing interest the day the loan is
Right.
dispersed. And then exactly the next semester, the next loan is dispersed, that starts accruing interest. So it snowballs by the time 4 years goes by.
Yeah, no, that's a problem. And then it sits there and sits there. So you had sent me some notes on things and some of this double consolidation, stuff like that. So why don't go over that? I guess we'll reverse it and we'll talk about how you could save for yourself on the back end of this. But while we're in here, so you got the Parent Plus loans. We're talking over 9%. So what's going on? What are some strategies? How do people handle that? Like what's going on with this relief, if anything?
Yeah, and that's the real challenge, is that in some ways there isn't relief for those who have borrowed Parent Plus loans in the same way that it is for their children with just regular student loans.
Okay. All the stuff that's been going on, the headlines, we just saw something again last week, as the current administration is wrapping up, where he, gave another $5 billion, $10 billion in relief. Now, from what I've seen and read, it tends to be more first responders, teacher, it's not for everybody. It just seems to be a certain element. I don't know if that's the right word, but a certain classification for who can get it. So if my kids had their own loan and they're not a firefighter and they're not a nurse, they're stuck paying it. So how are they determining who is or isn't getting these loan reliefs? Yeah, and who's paying for it? Because the money's coming from a bank. It's not, the government is only backing it. The government didn't loan it. The Bank of America lent it.
And actually, small point, they actually changed that in 2010. So it is federal money at this point. There is no program where it goes through a private lender at this point.
So it's straight from the government.
Exactly. The only loans that are out there that are still previously issued by banks and held by banks would be loans from before 2010.
So 2010.
To answer your question, it is when the federal government forgives it, that is now revenue that they are foregoing.
Sure.
In that case. So, yeah. And that's not to bring up something else and not answer your question right here first. But there is currently a lawsuit against the SAVE plan, and part of the standing in the first place was some of these loan servicers and states saying that they were going to be missing out on revenue as a result of potentially accelerated forgiveness on some of these loans. So you're absolutely right that it is a concern who's paying for this when these loans are forgiven.
You can't just make things disappear, right? Like somebody somewhere is holding the bag, right? I mean, I'm not against people getting their relief, but
absolutely. But
there seems to be a disconnect on the back end of it. But so Sally Mae, right? That's a term and a place. So you had Fannie Mae, Freddie Mac, and so Sally Mae, that's the student loan, whatever administration. So this is where people today, for their kid, they'd be going directly to Sally Mae for the student side, and then this Parent Plus for additional, right? So just breaking that down to the listener here. Okay.
Exactly.
So what's this double consolidation that you were mentioning to me offline?
So the challenge with Parent Plus loans is once you have them, your repayment options are more restricted than the options that your children would have. So exactly as you were just saying, that we may be hearing about all these different repayment options and forgiveness options that are available. I think that's a bit disingenuous to Parent Plus borrowers because in their case, if they do nothing, they have these loans, they wait for that grace period to end if they opted for it and they start making repayments, they're going to have very limited repayment options. And those repayment options are based off of their income. So you may have heard about income-driven repayment plans, and those are quite simply repayment plans that are based off your income. Functionally, it's like an extra tax. They usually look at your income tax return, they look at your adjusted gross income, and they make a few calculations based off your family size and the federal poverty level to determine what your payment is going to be. So as your income grows, your payment grows. If your income ever drops, your payment drops.
Okay. But that's no longer the case.
Well, that's going to continue to be the case. But for Parent Plus borrowers who do nothing, they don't have that option. Now, if Parent Plus borrowers take their loans and consolidate all of them, which is an option they can do, it unlocks one of the income-driven repayment plans, and there's currently 4 of them. And the one that it unlocks is unfortunately the most expensive of them. It's
sure.
Yep.
Why wouldn't it be? Why would it be?
And so in some cases, it doesn't provide any relief. Like if they're already struggling with those other repayment options that I mentioned, that income contingent repayment plan doesn't really always provide relief as well. Because again, amongst all the plans, it results in typically the highest payment. So that's where I really wanted to bring to your listeners today, Bruce, the idea of the double consolidation.
All right.
And so it's almost exactly what it sounds like. What you're going to want to do is you're going to want to take some of those Parent Plus loans and consolidate them into one consolidation loan, and the other chunk of your loans and consolidate those into a separate consolidation loan. And so there's some nuance. Oh, go right ahead.
So you're basically able or capable of consolidating and splitting. You had 4 years, right? And so you could take 2 years and put it here, and you take 2 years and put it here. Instead of putting them in all in one, you're going to run 2 simultaneous. That's kind of how you're structuring that. Okay.
That's the first step.
Here's a fundamental question. So if the Parent Plus loans, is it an open-ended payment schedule? Is like when people get a home equity line, they can do a variable line of credit, like a HELOC, right? And that's open-ended. You pay what you want. It might have a 10-year window or a 20-year window, and then eventually it balloons out or something. And then there's the fixed rate. And so it's a 5-year repayment, and the rate stays stable. So how do these work in conjunction or comparison to like a home equity? So when you're doing that, if I'm consolidating it, am I getting a 5-year term, a 10-year term, or is it open-ended?
That's a fantastic question. I just want to not leave open-ended, but I was talking about the double consolidation because that was only the first step. There's actually a second step that has to happen after that.
Go
so
ahead.
Any viewers who may be listening, don't think that was it. And we'll come back to that. But to answer your question, absolutely. So again, to the Parent Plus borrowers who do nothing, they will be defaulted into the 10-year standard repayment plan. So exactly kind of like you just said, they make the same payment month in and month out for 10 years, and that loan is then paid off at the end of it. So for Parent Plus borrowers who maybe only put one child through college and maybe we're only taking out $2,000 per semester, it's probably going to be a relatively small balance, and most people should be able to handle that within that 10-year time frame. But it's the Parent Plus borrowers who are really like taking it out to the full cost of attendance every semester and maybe had 2 or 3 or 4 children that they did this for to put them all through school.
Yikes.
I've seen some balances as high as over $300,000, $350,000. I've heard stories of up to $500,000 in just Parent Plus loans.
Wow.
So it can be a very
That's
big
painful.
problem.
And bankruptcy doesn't protect them from this, correct?
In very rare and extreme cases, bankruptcy will work, but I would not encourage anyone listening on this call to think that bankruptcy is going to get them out of these loans.
So, because the student loan itself no longer, that side of the student side, but I don't know how the parent side would.
Parent Plus
would
is the
play
same.
in.
It's you have to be able to demonstrate an undue hardship if you're required to make payments on the loan. So,
Right, but if I've got if I got a 500, if I have a $500,000 balance, okay, like just the math, you're talking $5,000 to $10,000 a month payments.
Yep.
I lose my job. I get disabled. I have a problem. How am I supposed to meet that obligation? Bankruptcy does not protect me.
So that's where we get to the other side of your question when you asked about maybe balloon payment or some more flexible payment. And that's where the idea of the income-driven repayment plans come in, is that instead of making payments that are based off of the balance of the student loan and the interest rate on the student loan, you're instead making payments based off your income. The challenge there, and I'm sure you're already doing the mental math, is that instead of those $5,000 or $10,000 payments, if you're only paying $500, that interest might continue to accrue.
You're not even covering the interest. You're almost in the negative amortization, right?
Exactly. It is negative amortization that you're struggling with. And that's where forgiveness becomes an option. So to bring it back to the double consolidation again.
Go ahead.
These Parent Plus
Sorry,
borrowers,
I'm trying to fill in the blanks, Glenn. I'm just trying to fill in the blanks.
I appreciate it's not
and most of the blanks are between my ears,
It is not an intuitive topic. So that's where, as I said before, Parent Plus borrowers do nothing. They will not be on a repayment plan where forgiveness is an option. But if they do that double consolidation, they can unlock those lower payments, make them affordable within their budget, and then they can pursue either public service loan forgiveness or income-driven forgiveness. That's more of a long-term forgiveness. So to your point earlier, they'd make payments for typically 20 or 25 years, and then whatever's remaining is forgiven under the long-term forgiveness option. And under the public service loan forgiveness, they just have to make 120 qualifying payments, so basically 10 years. And as long as they're working for a nonprofit or the government or some other qualifying employer, then whatever's left is forgiven tax-free. So for those people with those extreme balances, forgiveness is usually going to be the option they want to look towards.
But if they don't do something by June, they lose that ability. That's why we're pounding the table here for action.
They'll lose the affordable plans. They would still have access to that income contingent plan. But as I alluded to before, it's the most expensive of the calculated payments. So it doesn't always provide the relief that people are looking for.
Okay.
And that's why the double consolidation unlocks all the same repayment plans that your children will have access to. And those typically come with lower payments, but still those same forgiveness options I just mentioned, either 10 years under PSLF or 20 or 25 years under long-term.
All right, raise your hand if you're still confused like me, folks.
Yeah.
There's not much that gets to me or confuses me or I'm not familiar with, but this is definitely, when you brought it to my attention. And again, it's not, in fairness, you and I in general, this is not something we monetize from. We're not counselors on this. We're not paid for this. So, I'm poking fun at myself, but there's a limit to the knowledge base because you don't deal with it. Like when people ask me about Medicaid, not Medicare, but Medicaid, like that's like welfare. Like my clients have money. They're not on Medicaid and they're not on welfare. Why would I know about it? Right. Like, so, there's a limit here, but I kudos to you for embracing, digesting. And from what I understand, you speak on this and you that's why we're here is it's something that you're getting out the messaging of to be a, subject matter expert on so that people can figure this out. Now, when I look at your name there, it says CSLP registered trademark. Does that have something to do with college student loan programs? Because I can make that acronym up. Was I on the mark?
You got it. That is a certified student loan expert.
Wow. Okay. I didn't know that existed.
Loan professional. To anyone listening today, I think you're absolutely right that student loans are not an intuitive topic for anyone to understand. So I'm a certified student loan professional, but there are a number of us out there. And if you have Parent Plus student loans, I would encourage you to seek out a certified student loan professional who will be able to sit down with you, gather your information, look at your information, and tell you exactly what plans are available. And like this double consolidation, how they can walk you through those steps if it would be beneficial for you as well.
Wow. It's something, again, thank you. I'm learning something new. So quick shout out, give out your phone number for that while we're on that. How do people get a hold of you who like hitting pause button and saying, let me call this guy?
Appreciate it. Thank you. The best phone number is going to be 850-966-3225. And of course, I also respond to email as well. If they want to email me at Glenn, that's Glenn at shonengold.com.
SHONAN, Shonen.
Yep.
So on that same topic, is this a fee service? Are you consult gratis? Like what would somebody expect if they want to get your help that is involved in the relationship? What's the quid pro quo here?
Certainly. People can pay for these services. One is I do offer beyond just student loans, comprehensive financial planning. And I charge, I have a sliding scale, but I try to be more on the affordable end. Again, it's thinking back to those young doctors who don't have investable assets. I don't require you to have a minimum number of investable assets to work with me. Instead, I charge a monthly fee. Usually starts at $39 per month, and then it goes up from there based on certain factors. Or I also can charge an hourly rate. If you really just want focused student loan planning, you don't need anything else around investments, insurance, retirement, college planning, you name it. In that case, then I have an hourly fee, and it usually works out to be around $400 to $600, depending on if you're single, married, the complexity of the case.
No, I want to give them the so what, now what. So if somebody's sitting there going, look, I got $100,000 that I'm dealing with and I'm choking on it, and I don't really know what to do, and I don't know what all my options are. So ballpark, for $500, you can sit and work with Glenn remotely, I would assume just as easily as in person, so anywhere in the country. And hey, he can help you digest, break down, and direct you in what to do and how to fix. And then if you want more comprehensive planning beyond the college, then he has additional services that he can roll that into as well, or put you on another program. Is that a fair assessment?
Yeah, appreciate that a little plug there. And I just offer as well, when it comes to student loans, because we're talking about interest that's compounding over a number of years, the difference between the best choice and even just the second best choice can be measured in tens of thousands, if not hundreds of thousands of dollars coming out of your pocket if you make the wrong choice. So
no, 100%. I mean, your fee is modest at best and certainly recoupable in the first year.
Exactly. And that's my goal, is I want to make it affordable and accessible to everyone who needs it.
You may not know the answer to this, but it would accentuate the point. What's the average national cost for college right now? Like what are we looking at as a national average? Now, Ivy League is six figures, right? University of Miami down here is close to six figures, $100,000 a year, but that's not the national average. State schools are certainly way, way below that. But is it 30 grand a year, 40 grand a year?
Yeah, I think state schools are generally, it ranges between about 30 and 40,000 per year. And then private schools on up to 50, 60, 70 on up to those more exclusive Ivy League ones. So way more. Yeah, typically you're looking at best case scenario, somewhere just under $100,000 for 4 years, and then on up to 200,000 depending.
Okay. All right. Just to keep the clock moving here, anything else on the student loan side? Because, now that we kind of punched them in the face here a little bit with the problem, the other side is taking proactive measures and saving your own money, putting that money away. In 2024, the stock market, S&P 500 made 25%. So if you had put your kids' college money into that exposure, instead of having a 9% loan, you got a 25% rate of return, right? So, but again, not everybody has the ability to save. Not everybody knows where to go or have professional guidance. And then they have to borrow. And so the borrowing is there, but If you don't have a 401k to borrow against, which has limits, if you don't have a home equity line to tap into, which again is an outpouring of cost, you want somebody to put away $50 a week, $100 a month, whatever it is. When, we talk about the insurance side of having some, at least term insurance in place to protect mortgage and, fund college if a parent died well before it's funded. And then the flip side is they have cash flow and they want to save. They want to put money away. And I know you do that kind of work. So let's break down the options that people have, how some of these tools work. As I recall, there were 3 or 4 vehicles. You have the UGMA, UTMA, Unified Gift to Minors Act or Trust Act, 529s, Coverdale, and you can even use Roths. So let's break that down with your help here and talk a little bit about the pros and cons of some of those, what you personally can or can't do. I don't know where your licensing goes. So 529s are state specific, usually mutual fund programs versus UTMA. You know what? Candidly, 30 years, I never did a Coverdale. Never did a Coverdale. We did UTMA, we did 529s, and then on the tail end, maybe Roth, but Roth we didn't really use for college planning as much as the parent, planning. But hit me up, go back. Let's break it down.
Yeah, Bruce, I think you're absolutely right. Just kind of the broader context that compounding can either work for you or it can work against you. Taking out the student loans, as we've already alluded to, it's going to be working against you, very much so. But
sure.
The more proactive you can be in saving and investing for your children and their education, even if they're in middle school or the first couple of years of high school, just starting to save something now is going to save you a lot of trouble, in a few years. And certainly the younger they are, the more you can save, the better.
Yeah. Compounding of money, right? Time value of money, compounding of money. If you can make 10%, that $1,000 doubles in 7 years. So for a newborn, in 18 years to 20 years, you've got to triple. You've got to, quintuple on your money for at least that, that portion of it. So yeah, you got to make. And let's throw in one more headwind is it's not like college costs are level. You're chasing that inflation, which back in my day, we were pegging at 5% and trying to make 7 to 10% on their money to outpace the inflation increase, right? So when I say to you what the national average is and Ivy League, that's the word I'm looking for, is $100,000 now. Well, certainly when I was going to college, it wasn't, it was more like 30 grand. So, in 40 years, it's gone from 25 and 30 to 100, right? So,
and
go ahead.
Like you just said, for planning purposes too, I actually use 6% when I'm trying to project out the growth and cost of college education.
Well,
so
I appreciate that. And you're not underestimating.
No.
You'd rather overestimate and make sure there's no shortfall and rather have extra money left over. So good for you.
Yep. And that's one of the benefits of the 529. I will say all those other accounts, the UTMAs, the UGMAs, the Coverdell, they have their uses, but exactly like you said, I've also never really had to implement a Coverdell, and the UGMA and the UTMA usually is in addition to something like a 529. And that's where really the bulk of your savings probably should be going. And
let's tell them why do you think that?
Well, first and foremost, you can get far more money into it than you can the Coverdell or some of the other accounts. And in addition, one of the things you just alluded to as well is they changed the rules a few years ago to make it easier to get that money out for various reasons. So I know there's been resistance in the past that people say, I'm not sure my kid's going to go to college. I'm not going to want to put it into this account that's going to lock it up and I'm going to have to spend it on college if they don't go. So there's been opportunities and changes into that. Some of it you can put right into your retirement accounts. I think there's some limits on that. So it can be a way to save for retirement if there's anything left over. Additionally, if one child doesn't go to college, but another one does, or maybe you have a niece or a nephew who's going to go as well, you can transfer the account to someone else. So,
but this is you're still on 529.
This is all 529s, exactly.
Right.
So there's more flexibility than there used to be with them. But in addition, you can fund far more money into them. Usually the limits on them are measured in hundreds of thousands of dollars, something like $400,000, $500,000.
Well,
And you,
correct me if I'm wrong. I'm sorry. Again,
no, go right
my
ahead.
knowledge base is a decade behind you a little bit, but the there was a gifting cap on 529 funding, but you could accelerate. There used to be I think a 5-year acceleration. So if okay,
This year it's $90,000. So if usually the parents don't necessarily have
right,
that much money they want to front load into a 529, but grandparents
right, exactly.
usually might be sitting on some extra money, don't know what to do with it, want to help out their grandchildren.
That was my target.
Yep.
I usually had the parents who were becoming grandparents, and they wanted to do something for the new baby, and so we could do that. Now they didn't necessarily put away 90 grand, but 5, 10 grand, whatever, to kickstart it, and then try and get their kids to put that 100 a month away and get it going. So that was kind of the MO. So allow me for a second. So the 529 feature, when it was construed and built, was state-based. And some states, like I was in New Jersey, and they had a convoluted plan, but let's say Florida, because you and I are in Florida, is the Florida 529 is kind of buying the credits at today's price that's indexed to inflation. So I think that's where you were going with some of this, is that if inflation's 6%, you get 6%. If it's 9%, you get 9%. But it's not necessarily a credit as much as if you go to Florida Atlantic, if you go to Florida State, if you go to University of Florida, and it's $200 a credit today, your $500 is going to buy you 2.5 credits, and whatever the math is. So now when the kid's 18 and a freshman, they've accumulated 240 credits to pay for the 4 years of school. That's pretty much right. So based on your state program, that's where certain opportunities lie. So if you lived in Florida, thought your kid was going to go to a Florida school, you could buy, and I think there's a certain name to the program, isn't there? It eludes me at the moment. But
so you've mentioned there's two different types of 529s actually, and what you've mentioned there is the prepaid plan.
Prepaid,
That's
right?
Exactly.
Florida prepaid, right? Florida prepaid.
Yep.
And the other one is you can invest. The other one is you can invest, right?
And in that one, you have any sort of investment options like you would in a retirement account. It's up to you to determine your risk and return profile that you're trying to look for. But then there's more flexibility when it comes time to withdraw the money in what school that your child might attend. You're not necessarily locked into the Florida school system. I think there's some ways that you can get some of that money
there's out-of-state
if they want to go out of
there.
state, but it's usually less beneficial and better if they stay somewhere in state in that case.
But Glenn, again, I don't know what's changed in the years since I've done them. So I just want to hit the point. So from an investment only standpoint, the state specific plans, like when I worked at Merrill Lynch, the Merrill Lynch 529 was out of Alaska. That's how they structured it. It was an Alaska plan. And then again, this is way back. It had Merrill Lynch mutual funds available in that platform. Now, Merrill Lynch doesn't have their own mutual funds anymore. They sold to BlackRock. But if you wanted Putnam, you had to use this state. If you wanted, and I don't think Fidelity had them at the time, you had to use that state. So certain states gave you access to just a certain bucket of mutual funds that were maybe target-based, age-based, risk-based, like you kind of had that. So it wasn't a free reign of, imagine if you bought Apple stock 20 years ago for your kid and how much money you'd have in that plan. That's where the UGMA would come in, is you could pick what you want. You could buy stocks, you could buy bonds, you could buy mutual funds. Like that was a brokerage account with full array of investments. So has any of that changed from when I was doing it?
Very similar. So I'm going to try not to confuse the listeners here. So we mentioned the state prepaid, and that right. I think all 50 states have something like that. And when you opt into that plan, usually you're restricted again to having your child attend school in that state. But there's no real investment portion to it. Right. It's really almost more of like an insurance plan.
It's a
You
tip.
have
It's a
specified
tip,
exactly.
right?
You have
It's a
a
treasury
predefined
investment.
payment,
Yeah.
and that payment pays for, like Bruce was saying, a specific number of credits. I know in Florida you can pay a higher amount if you also want it to cover room and board. So there's some flexibility in there, but it's a payment plan you can plan around, and you know exactly what it's going to pay for once your child goes to school.
Right.
The investment plan.
It's a
Sorry.
lower risk. I'm sorry, Glenn. It's a lower risk profile because all you're doing is locking in today's price in the future.
Exactly.
There's no upside, but then there's no downside, right? So there's
You're
a
not
certain
gonna have a bunch of
audience.
money left over. You can move
Right.
to your retirement account after your
Right.
child graduates with that plan.
But if I'm more of a risk taker, if I understand the volatility of the markets, if I want to pick my own investments and deal with a loss if a loss comes about, right? Like it's up and down. Or I need a higher rate of return because I'm not as capable of funding as much money, then I need to chase. I need to be a higher risk profile where I'm using Apple as an example, but if Apple made 50% last year and the market made 25 and the inflation index was 6, like look at the difference in performance, right? Like it's 6 versus 25 versus 50. So my $1,000 is becoming more faster, right, folks? So understand that there's differences there for different risk tolerations.
So to answer your question about where they can go to get these investment accounts for 529s, again, they're usually administered by the state, so you're absolutely correct there. But you don't necessarily have to open an account in the state you live in. So we're here in Florida, but if we had children and wanted to open accounts for them in Nevada or Indiana or some other state, there's no reason that we can't do that. And even to your point, so my company, we partner with Charles Schwab. And whenever we open 529s and help to manage them on behalf of clients, it's actually done through the state of Kansas. So they have one of the more favorable ones in flexibility and financing at colleges anywhere.
But this is kind of in conjunction with Schwab, like I said with Merrill Lynch. Is Merrill Lynch went and got one, and it had to be run through Alaska. You didn't have to be a resident of Alaska to participate. So similar in that sense with Schwab. It's just,
and that's only for folks who want to work with me, that you're locked into Kansas specifically. But I also advise on outside accounts. So if clients do want to go to that different state, and there's sometimes reasons to do that because they might have different investment options. Like I know Bruce keeps mentioning Apple. In state of Florida, you can't buy individual stocks, but there may be a different one that allows you to if that's something you want to do. So that would be a reason why you may want to shop around in different states as well.
Okay. If I may, the UGMA was the early on choice when I started in the late 80s. It was a gift, Unified Gift to Minors Act, it was called, and you would make an annual gift, and it would be held, depending on the state that they lived in, till age 18 or 21. And again, this is before 529s existed, and it was investment driven to whatever the owner, the client, the parent wanted to put the money into. So way back when we were doing zero coupon bonds, right? And then eventually mutual funds and or stocks. And the hurdle, if you will, that the 529 became a little bit of a solution for was when the kid turned 18 or the kid turned 21, it's now their money. It's in trust for, daddy's funding it, grandma's funding it for the baby until the baby's of age. So if you have $100,000 in there and your kid has no interest in going to college and is, let's say, a deviant of some sort and in jail and having all kinds of issues, the last thing you want to do is give them $100,000 you put aside. Tough luck. Right. And so that was the trust factor the parent had to have in the upbringing of their child, that if they became a Hell's Angel, well, they now have $100,000 to go buy a motorcycle and, do what they want. So the 529 kind of wrapped that protection a little bit differently from mom and dad, right?
Well, especially from the college planning perspective, like they can't necessarily take their 529 and go
Buy
buy
a
a
bike.
sports car or whatever. But
Well, they
most
can. They can.
there just going to be
Right?
some tax consequences. Yeah.
There's tax implications. The difference is, Glenn, it's not the kid's money to do so.
Yeah.
Dad can take the money out and buy his own Ferrari if he wants, and it's now going to create taxation. But it's not the kid's money. And that was the difference between the two platforms. Is it gave that insulation to the parent for the direction and control. The word's control, right? Who controls the money at
Yep.
the time of need? And so the UGMA, once again, most of my clients never had a problem, right, with their kids. But once they became 21, we had to retitle the account. And now I had to get permission on transactions from the child, from the kid now. It wasn't dad who had the ability. So you had to transition that money over. That is not the case with the 529. That's where I'm trying to rubber stamp.
Yep. And the issue that you just highlighted as well is the reason why UGMAs and UTMAs aren't great for funding college education is because when it comes to filling out the FAFSA, the annual form that parents have to fill out, those assets, now that they're in the child's name, they count 100% rather than some, other percentage formula if they're in mom and dad's name or grandma's name. And that makes them a lot less likely that they're going to get need-based financial aid. Because then they're going to be expected to then pay out of their own UGMA and UTMA and other financial resources. So it is not advantageous to plan for college using those accounts.
And great point, and I'm glad you brought that home for us, because the challenge with all of this is what level is the audience, right, and the clientele. So if you're super affluent, these tools all work for you, and they're great devices. You're at the bottom end, the financial aid is going to be a lot higher and maybe very little need for the loans. And of course, it's always the middle market that is the tweener, right? And so they can put away a few dollars. They can't really put away all of it. They're going to have to borrow some money along the way. And then, they may or may not restrict where their kid goes to school because of the funding and ability to pay for it, right? Like I've had many clients over the years that the kid got into Ivy League, but the parent couldn't afford it and the kid didn't get to go. And that's a big pet peeve of mine of like, shame on you. Your kid was good enough to get into Ivy League, figure out a way to pay for it, and the fact that you were spending your money and not saving your money to deny your kid that was always something I tried to, help alleviate of like, look, why deprive the kid an Ivy League education if they earned it, right? If they're smart enough, figure it out a way to pay for it, right? My soapbox.
Yep.
But, you brought great points. And again, I'm thrilled to see this CSLP even exists, that there are people out there. That was definitely not something available in my day. We did the limited type of, work, whether it was the UGMA, the 529. And so now there's professionals that are really geared with an extra knowledge